The oil market fracture. Why $90 oil predates crashes. We are seeing it again. Oil prices have spiked, and more importantly, they are staying high, consistently holding above that critical $90 per barrel level.
I'm not sitting here and saying that long-term investors should start selling their stocks. There's no indication that we're going into a recession.
I mean, look at WTI.
Yeah, right. Historically, this is not just a statistical quirk. This is an actual warning sign.
The 70s or even the Iranian Revolution. So this is pretty unique. So I'd put it more serious than anything we've seen since the early 1970s.
Every major market fracture and nearly every great recession over the last 50 years was either preceded by or accompanied by a massive surge in energy costs. Today, I'm going to explain exactly why $90 oil causes the economy to fracture, and then I'm going to list the specific historical crashes that followed this exact pattern. Now, why $90 oil is the economical breaking point? It isn't a magical number, but it represents a threshold where energy cost transitions from a manageable expense to an economic suffocator. Oil isn't just gas for your car, it is the input cost for almost everything. When oil stays above $90, transportation costs for all goods skyrocket. Manufacturing costs for plastics, chemicals, and fertilizers surge.
This forces companies to do one of two things.
They protect their margin by
Raise prices or absorb costs. It's a lose-lose.
which kills corporate earnings. At the same time, the consumer is getting hit at the pump. We have all seen this at the gas stations recently. This reduces their disposable income for everything else. So you have rising inflation and slowing consumer demand simultaneously. That is the definition of stagflation, and it's how high oil prices fracture the economy. Now, the historical evidence that I want to list here, I'm not speculating. I am literally reading the history book. Let's list the major market fractures where high oil was the primary trigger. You got 1973, the OPEC oil embargo. Oil prices quadrupled practically overnight. The resulting inflation and energy shortages triggered a painful 2-year recession from 1973 to 1975, and that was the end of the post-World War II economic boom. Another, 1979, the Iranian Revolution, a second energy crisis that sent prices soaring again. This caused the painful double-dip recession of 1980 and 1981 and 82. As the Fed was forced to raise interest rates to 20% to fight the inflation caused by high energy. Another in 1990, the Gulf War, when Iraq invaded Kuwait, oil prices nearly doubled in a few months. This short, sharp shock was the primary trigger for the 1990 and 1991 recession. And here's one we all know. In 2008, the Great Recession. People tend to forget about this. But right before the subprime crisis fully exploded, oil prices hit an all-time inflation-adjusted high over $147 per barrel in July of 2008. This massive energy shock was already crippling the consumer and manufacturing sectors before Lehman Brothers collapsed. We need to respect this history. When oil spikes and stays above $90, it acts as a tax on the entire global economy. It increases inflation while decreasing growth. The fact that oil is holding these levels right now tells me that the market is far more fragile than the headlines suggest. I am positioning my portfolio defensively, focusing on cash, energy producers, and defense contractors. I am not waiting for the crash to happen. I am preparing for the fracture that has already begun. Stay safe, and I'll see you guys in the next video.